Hello everyone, this is Boss. Today we're going to dig deep into some intriguing developments in the U.S. economy as it pertains to the latest employment data, the actions or inactions of the Federal Reserve, and the broader global consequences facing nations navigating through challenging financial waters. Get ready, because today's show is packed with satirical insights and critical reflections on how policy mismanagement is creating severe economic distortions, unsustainable growth, inflationary surges, and ultimately, a cycle of job insecurity that poses risks not just to the U.S. economy, but on a global scale. So, the headlines read, U.S. job growth in September tops all estimates, unemployment falls, wage growth accelerates. Doesn't that sound like great news? After all, 254,000 new non-farm payrolls, an overall unemployment rate dipping to 4.1%, and a wage increase to boot. All seem like indications of a strong, fundamentally sound economy, right? Hold your applause, because when you dig into the numbers, what we see is more like a superficial band-aid on deeper structural problems. And that's what mainstream media, politicians, and yes, the Federal Reserve are all very good at masking. Let's break down the numbers a little more. Non-farm payrolls. Yes, it's true. Over 250,000 jobs were added, the most in 6 months. But look closer. The majority of those jobs came from leisure and hospitality, sectors with a high turnover rate, low pay, and often part-time positions. These generally aren't the types of jobs that drive middle-class growth or strengthen economies in the long run. Can we really declare the labor market healthy when the jobs we're creating are mostly in temporarily recovering sectors that were decimated by COVID-19? Wage growth. It's up 4% year over year, which sounds decent until you remember that inflation has been eroding purchasing power across the board. When prices are rising at similar, if not faster, rates for essentials like housing, food, and energy, an increase in wages doesn't necessarily translate into better living standards. Inflation pulls the rug out from under wage gains, ensuring that most Americans aren't truly seeing real, inflation-adjusted improvements in their finances. Participation rate stalls. While unemployment is lower, the most telling statistic here is the labor force participation rate, which held at just 62.7%, a historically low number. Why is such a large chunk of the U.S. population still not in the workforce? The real question mainstream outlets and administration officials don't ask. Is the job growth we're seeing truly sustainable, or is it an illusion built on precarious foundations? The Fed is playing its usual card, patting itself on the back for keeping the labor market somewhat afloat. But the questions remain. For how long? And at what cost? A major part of this story is how the Federal Reserve responds. Did you catch Jerome Powell's remarks? He and the Fed have been walking a tricky tightrope, on one hand trying to control inflation, on the other, attempting to shield this fragile labor market. They've already undertaken a series of interest rate hikes this year, yet despite their actions, inflation remains stubbornly high in many areas, while wage growth and employment seem to move more sporadically, reflecting uncertainties in the economy. Many were expecting the Fed to implement another big interest rate hike in November, but this latest jobs report has tempered those expectations. However, here's the problem. The Fed has very little room to maneuver. They're stuck. Raise rates too much, they potentially crush the job market and trigger a recession. Leave rates too low, and inflation continues to eat away at household finances. Table that with Fed Chair Powell's goal of a soft landing, a mystical economic feat that exists more in theory than in real life, and you begin to see just how precarious this economic balancing act is. It would seem that the Fed has signed itself up for a losing game, reacting to short-term indicators like jobs reports while ignoring long-term structural issues that are bubbling beneath the surface. Over-reliance on rate cuts after a prolonged low-interest rate environment has inflated housing prices, asset bubbles, and corporate debt, dangers that continue to loom as rate hikes ultimately impede economic activity. So, what have we gained in exchange for their policy gymnastics? We might have averted a full-blown crisis for now, but the underlying financial vulnerabilities remain unaddressed. Let's not ignore the political ramifications coming into play here. With Vice President Kamala Harris gearing up for an election season where economic stability will be a key talking point, this employment surge seems like a timely boon. Convenient, isn't it? Americans, however, aren't as naive as some political strategists might wish. They can feel the effects of increased costs at the grocery store and with their daily expenses for utilities and healthcare. Poll after poll shows that Americans remain deeply skeptical of the economic outlook, especially as inflation pressures weigh on consumer sentiment. Americans are taking on more debt just to maintain their standard of living. According to the Federal Reserve Bank of New York, total household debt reached a staggering $17.06 trillion in Q2 2023, an alarming figure driven by soaring credit card balances, auto loans, and mortgages at historically high interest rates. An economy that fuels growth based on unhealthy consumption patterns made possible by debt is not sustainable. It's a ticking time bomb. Consumer sentiment around inflation is clear. When the cost of living grows while wages barely manage to keep up, people feel the squeeze. All of this could spell trouble for policymakers come election time, when voters are less likely to buy into rosy employment figures and instead cast their ballots based on the financial realities they endure day to day. What happens in the U.S. doesn't stay in the U.S. Let's zoom out and look at the global job market. Job cuts aren't just an American story anymore. Layoffs are picking up in some of the world's biggest corporations outside of the U.S. For example, Samsung Electronics is cutting staff across Southeast Asia, and Volkswagen AG is scaling back in both China and Germany. The trend reflects vulnerabilities in the demand for goods as businesses prepare for a global economic slowdown. This is part of a larger narrative that crosses borders. The global economy is struggling to maintain balanced growth while many countries see trade stagnation, weakening consumer demand, and an uncertain outlook for global supply chains. And don't even get me started on China's economic slowdown. Although Beijing seems to downplay these figures, its post-COVID recovery has been much slower than anticipated, with its sluggish GDP growth dragging down global economic forecasts. Germany, the manufacturing engine of Europe, is slipping into recession territory, as its heavy reliance on trade and industrial production is starting to boomerang back, especially in a high-energy cost era exacerbated by Russia's war in Ukraine. All of this contributes to weakening global demand, ultimately affecting job growth worldwide. And speaking of international instability, let's not forget the geopolitical risks that are increasingly intersecting with economic risk. Hurricanes like Helene in the U.S. Southeast are real-world events that stall production and put additional pressure on fragile economies. Natural disasters are often compounded into economic disasters, especially in a climate that seems to become more unpredictable with each passing year. So, with all this data bombarding us, the core takeaway really boils down to one question. Are these wins sustainable, or is this merely a mid-cycle relief masked by a veneer of better-than-expected employment reports? The idea of a resilient, growing labor market is tempting to buy into, but the warning signs are clear. Wage growth that lags behind inflation, political smoke and mirrors in the form of cherry-picked job data, and a precariously balanced Federal Reserve struggling to contain inflation without crushing jobs. These form a cocktail of unaddressed systemic weaknesses. Make no mistake, these challenges extend beyond the borders of the United States. The world's largest economies are grappling with similar concerns. High debt, inflation, weakened consumption, and precarious job growth. We're teetering on the verge of a global slowdown, with economic tremors already shaking up supply chains and headcounts in multinational corporations. Ask yourself this: when this massive post-pandemic stimulus bubble starts to deflate, who's going to bear the brunt of the economic catastrophe? If this global labor and economic trend continues its current course, we all know who will face the biggest struggles. It won't be the central bankers or those on Wall Street, but average citizens worldwide. So what do you think? Are we walking too close to the edge here? I look forward to hearing your thoughts in the comments. Remember to like, subscribe, and keep following our deep dive into how economic policies impact you, from point to surface. Well, that's everything for today's episode. Stay alert, stay informed, and don't buy into superficial narratives without understanding the full story.